Okay, we have commenced recording. I'm Tim Quast with Market Structure Edge. Along with me today is Brian Wilson, as usual, market strategist. And so I think I have to go first today, right? So I'll take the first half. Brian will take the second half. We'll aim to be done very close to 3 p.m. Eastern Time, 1 p.m. Mountain Time. You know, it's what we aim for. Just try to keep it short and focused. I will. I'm going to begin this way. Let's see. I'm going to, if I can, give me 1 second here. Make sure I'm in the right spot. I just walked in here, and I'd like to be a little further ahead than I was this time. I'm prepared, but I didn't have the right screen up. Okay, I'm going to share my screen. Okay, so here's where I want to begin today. So I have said, one of the things that I've said is, it's historically, it is very unusual for the market to surge from a bottom near like 5.5, that sort of thing. And so your response might be, well, that was pretty wrong, wasn't it? Because there the market went, it surged. Well, yes, it did, right? It is unusual. It's no question it's unusual. But here's the interesting thing. It's not that the market doesn't rise in some meaningful, we have these snapbacks fashion, and we've talked a lot about that. If we backed up a year ago, well, primarily in October, we started to talk about how the snapback market would at some point end, which it did in February, and then we had trouble. So when that snapback sequence stops, things tend to weaken. And by no means am I looking for the market to weaken or to rise. That's not the point. I'm not, I don't have a bias per se. I certainly have expectations for a market that stays in this same range. I think a market that is dominated by, let's call it, volatility arbitrage is not one that can sustainably rise because money is consuming the returns and it's not really additional flows. Now, who knows? We'll see what happens. But certainly the market did surge. Right? So it did from not even neutral. So we bottomed around 5.3. That's that number up here. It's going to change as my cursor moves. Here's what I want to show you, and I have an image to point this out if I can get to it. Let me just see here. Where did I put that? Did I put that in here? If I can't get to it, I'll just show you what I mean. I had nicely drawn arrows. I don't see it. So, okay, let me just go back here. I'm going to back up a hair. Let's do a 3-month view. And this first topic is about how good demand is as a short-term measure to tell you what's going to come next. Now, maybe there's something else that's better that I'm unaware of. But here's what I mean. There's the red line, that top line here. If you're colorblind, it's just that the parallel line. You have two parallel lines, a top line and a bottom line, green and red. Most of the time, the market averages 5.4. It sits in between them. And very consistently, when it gets to the red line, this green part of the graph, when it gets there, the market declines. It gets, near to this level, the market declines. Gets near this level, the market declines. Gets near to this level. I'm not predicting that the market is going to decline, but certainly it is not shooting higher as it did the last, 3-4 days out of this very volatile period. It is an excellent short-term read for managing risk. You could say, well, every time you get to that, the probability of producing positive returns from long positions diminishes. The daily trading ideas have worked very well. They have. I mean, you can buy late in the day and exit the next day pretty consistently, so long as you have fairly wide parameters for how much price might move. You can get stopped out very easily. I don't like to have stops as a result of that because I can see how much volatility there is. And so you have to be willing to risk at least half of that, if not more, the probability that the stock will move that much. And if you don't have those parameters, you can get stopped out, and then the stock gives you your gains, but it's, you're out now. So you have to be aware of that. And I think Brian might be talking about that a little bit here. But then why would we continue to snap back from these, steep declines, but the declines do not continue? Now, look, I don't know what all the answers are, and I'm kind of blending the four things that I wanted to talk about. But, this to me is a product of the ETF model. And we wrote about this. I wrote about this. I say we as an organization. I happened to write it, but it was our weekly blog at Modern IR, the company that provides analytics to public companies. We wrote about how there was this massive pattern. It doesn't have ETFs written on it. It's just that we see this pattern very consistently operating in very predictable ways, which is how ETFs behave. I mean, we know what all the fund flow data is. We know that in 2026, $1.3 trillion a month moves into and out of ETFs through what are called creations and redemptions. Well, if there's going to be market making associated with that, that is people trading the movement of money into and out of ETF shares, it's going to manifest in the marketplace. It's far and away the largest thing. I mean, it's way bigger than any form of fund flows put together. You can track fund flows in a variety of ways. There are a lot of tools that will do that. And you think, well, why wouldn't you just use that? Because it doesn't tell you what the market's going to do. It's not a good way to understand what the market's going to do. I mean, money has come out of equities fairly substantially, looking at the Bloomberg data, but you wouldn't know it with the markets trading at record highs. Well, how could that be? Well, I would attribute a lot of it to the inflationary effect that ETFs have. They permit more money to chase the same product called equities. There was a guy, in fact, I paused the program on CNBC because I want to go listen to it, that the head of ETFs for BlackRock is going to be on. And the tease into it was, which I shared with Kelly Evans and Brian Sullivan. I said, there are 5,000 ETFs. There are only 3,000 underlying stocks. So how could 5,000 ETFs give you all this diverse exposure to the markets when there aren't enough stocks to do that? Well, this is what happens. If you have a steep plunge, there is an opportunity to trade one thing versus the other. So they're supposed to be roughly equal value. Like I give you $10 million of stocks and you're BlackRock, and you give me $10 million of ETF shares to turn around and sell at a very modest profit to the public through Schwab, whomever. That's how that system works. But what if there's a huge sudden displacement, a disconnect between the value of the stocks and the ETF shares? Well, if you're a trader, you would say, I can close that gap. And that's how you get these wild, whopping moves. And in our pattern data, and you might say, well, why wouldn't you put that pattern data on Edge? Because it by itself, it adds it's difficult to know what it's going to do. But we could see this pattern. We saw the pattern increasing to colossal size and the market tipped over, and it proceeded in mathematical symmetry down the other side of the mountain and stocks shot up. What would one conclude from that? Well, I mean, if you're looking at it as a predictive tool, you don't know which way it's going to go. Demand and supply are predictive. We can look at this and go, supply is now rising. It didn't bottom like it did back here where the market got higher. So what is the probability, if this is at the red line and this is rising, that the market continues to rise? Well, not very good. I can't give you an exact number. We know how much the market tends to rise at the red line. It's about 0.5%. But the market has moved, it's caromed higher. So we've already had that move. So the probability, if the market mean reverts, is that it comes back down some. I don't know what that's going to be. But it's a connection. And the beautiful thing is we can measure all that. And so the core takeaway for you as an investor or trader using the data is be very aware of the red and green lines. We rarely get to the green line, which is a great opportunity, but also tends to be the end of a cycle. This cycle has not ended. I could certainly, it has not ended in a quarter. And, I certainly thought it probably would, and it hasn't. So I'm wrong there. I don't know when it's going to end. We'll just watch the data. I do know that probably a snapback that fails is a pretty good indicator of something to watch for. And here's what I mean by that. If you back up to year to date, maybe I'll go just a hair for, let's do 1 year because it'll be easiest to see here. And Brian, I'm almost finished and I'll hand this off to you. So here's what I mean. You could go back to, here's the snapback, right? The market plunged in October. This was a very dramatic event. There in multiple ways. This was the breakdown that culminated in this. I mean, that's where the market really, and you can see it in the data. I talked about it a fair amount then. It was one of the great volatility events really in the entire data set. Then, we had a little one here, another one here, another one here, another one here, another one here, and then this one did not snap back. It went sideways. So this was the breakdown that ended it. Now, I don't know what's going to happen here. We've had a snapback, a snapback, a snapback, a snapback, and I don't know what happens next. But it's very observable. And it's really nice to not have a whole bunch of cluttering signals of different kinds, just looking at demand and supply. What happens? And these drops all proceeded, followed tops or aligned with them. It's not always perfect, but it gives you a pretty good idea, right? And you can always look at the supply side and say, is it rising? Is it falling? Is this a big, if this is a bottom against the supply or to rise, what's it going to do to prices? Probably harm them. And you can see that all over. This appears different from everything else back to here. Who knows? I don't know what's going to happen next, but the core takeaway, again, to repeat myself, is the wonderful usefulness of being able to see whether we are at a top or a bottom and what supply is telling us about what comes next. So how long and how much do we retrench if mean reversion happens? One of these times, I've said, it's going to break, and it does periodically. It broke here. It really broke here, and somehow we got out of that. And I would attribute it to ETF arbitrage and the fact that there's so much money in ETFs that it continues to mean revert. And a lot of that's conversion from the active funds, 40 Act, passive index funds. They're all converting to ETFs because they're infinitely elastic. They're very inexpensive. You can offer them at a very low cost to investors. So it's what everybody has chosen to do. And so that conversion, the continual flow into that instrument bolsters the market, even when, if you looked at the big picture, more money is going to fixed income and money market funds and so on than it is to equities. So, at what point does that change? I don't know. But I feel like we will get good signals in the data that will tell us of the risk. Look, there is a risk that the arbitrage mechanism breaks at some point. There are only two risks to the market, as I say: flows change or the arbitrage mechanism fails. That's it to me. There can be inputs that cause it, but those are the things that we watch for. Okay, Brian, I will cease speaking and hand it to you.
Tim, I'll have you speak a couple more minutes if you don't mind. Could you give the participants an update on where we're at with the model portfolios?
Thank you for the reminder. Right, we want to do this every time, and I forget if it was Anesh, if it was you, but we will do this each time. So, right, very quickly on the model portfolios. And I found kind of an interesting one. I'm using some criteria that we haven't applied that much that are in the data set. There's a really interesting mega cap right here that we haven't put into the model portfolio file yet, but because there are a couple of things I wanted to figure out, and I had to talk with one of our engineers to do it. Did that today, haven't figured out. And so I will, it's pretty impressive what that model portfolio does with just a handful of stocks, but it's not fully refined yet. So going to the model portfolios, we have 4 of them in here. There's the focus and the core. There'll only be one core that we're putting in the note every day. and we've stayed focused on the passive model, the focused passive model. But there are three others, So the contrarian model.
Could you share your screen, Tim?
Oh, thank you.
If you have something to share.
Yeah, I haven't yet, but yeah, it's good. Let me do that. So here's the folder. So if you're a subscriber and you get the email every day at 7 a.m. Eastern time, it'll have a link in it that takes you to this folder. And so, we highlight the focused passive portfolio because it's the core model. And it did great, but hasn't is it outperforming the market? Yeah, but it would depend on when you started using it, right? If you started using it, I'll click through. I don't want to take up too much time here, Brian. Here fairly recently, I'm going to go to the performance chart. Look, from early in the year, it did great. And it shot all the way up to almost 55, 56% returns. But it hasn't been good since May options expirations. It's basically tracking the market, right? So, in fact, that if you were tracking standard deviation in performance, which we do, it's close. It's not been great, and I look at that and say I feel like we're not out of whatever cycle we're in because passive money, which we're following, would tell us so. It's just a way to see it. The momentum portfolio. This is the classic model that we have run for years that did really well last year. And year to date in 2026, where's the performance chart? And again, these are trying to pick just a handful of stocks, so it's very easy to manage. Did not do great until May, and then it exploded, and it's done pretty well, right, relative to the market. It's up, call it 35% or so year to date. But again, it would depend on where you started using it. If you started using it here, you're probably not very happy because it hasn't really done anything. But they're interesting models that you can look at and make use of. This is what I prefer doing right now. I just don't have time right now for daily trading ideas because I got too much going on. But these are easy because you just have to make one decision per day. If it says to rebalance, you rebalance, and I just program it to happen. I like market on close orders. It means that your performance may differ, but it works pretty well. The contrarian model, I say it looks for junk. It's not what we. I don't know why. Did I? I don't know why I don't see that. It's looking for stuff that is basically won and heavily short that may improve, and particularly in bad markets where arbitrageurs are going to look for stuff that has diverged widely. That's what we're banking on. Look, I would like, let's embrace the contrarian model. I will never say that, but it's interesting to look at what it picks up. And the best one to me, I don't know why this is happening. Maybe I need to refresh. The best is Focus Fives. I'll just say that I think that is a really useful portfolio because it's looking for stuff that is lower volatility, large, liquid, easy to buy and sell, and it's just been a workhorse performer. It's not awesome returns. It's since June it's up 13%, and again we didn't run it all the way back because it's like, well, you switch horses. If the model isn't working as of May options expirations, we looked for other horses, and Edge Focus Fives has been a really excellent performer. Okay, that's plenty. All right, Brian.
Sounds good. Thank you. Great to see everybody again. Thank you so much for coming to these meetings. We appreciate it. I'll run through a couple of items. We had a couple questions about SpaceX. I was actually planning on going there, so I'll go ahead and take a look at that. A couple of days ago, I wrote about SpaceX in the Daily Note, and to the point of demand and supply. I mean, this is a really good lesson. Would you buy this going into earnings? Fully washed out at 1 out of 10 coming into earnings. Short volume had been increasing, sure, you can get a contrarian play, and actually SpaceX is in that contrarian portfolio. It's been there a couple of days recently, but it's not one that you would generally buy. What did SpaceX do with earnings? It went from 125 down to 108, getting a little bit of recovery today. But as a general principle, yeah, you would not touch that with a 10-foot pole. Demand is washed out, short volume is high, and a couple people had questions about short volume in the questions today. It remains a bad setup. Now, are people perhaps hedging ahead of the lockup expiration today? That's certainly a possibility. So maybe we could get a reversal here because of that. I don't know if that's what occurred or not. It'll be interesting to watch here in the short term. But just as a supply and demand lesson, if you're coming into a big event, yeah, you would not touch this one. It's just not one that's a good setup. As you're familiar, and we won't spend a lot of time on it, but just a quick review. The daily trading ideas every single day has a number of ideas for you. I'll sort them by probability, and then I drop them into a watch list. If you look at the names today, there's a lot of potential names to trade here at the end of the day. What do I mean by that? Well, everything's doing pretty poorly today. It's not a good momentum day. There's only a few names, and here's the momentum portfolio today. Everything's generally red. What that means is if you can buy at the end of the day, and you will for almost all these names, there's a very good possibility of making 2%, in the next 1 to 5 days. Now, of course, I love to make 2% the next day. That makes it easy. These are the names that I'm currently holding right now. These are all daily trading ideas over the last 2 to 3 days, I think. I actually made money in LTH 2 different times, down a little bit today. So I'm just holding these names. Once again, that principle of 1 to 5 days. But what you do want to do is pay attention to the entry lows and entry highs. In other words, don't chase it higher. If LTH was, trading at 46.50, don't want to buy that name that particular day. It's moved above the entry high. I did mention today. I talked just a little bit about the semis. Now, why did I bring that up? Partially because it just exploded higher recently, and sometimes the semis can give you an idea in terms of it can be a little bit of a risk appetite gauge. So what you see on the screen here, S&P 500 in blue, semis in gold. It's a good lesson on a couple of fronts. Look at the inflection point here for the semis. End of June, everything was ripping higher. What do we potentially have? Well, a potential inflection point where strategies and tactics can change. What do we immediately see? We saw pressure in the semis that lasted all the way through what? An inflection point once again. We get to the end of July, semis move higher. On a 1 week basis, it was up 15%. I mean, just out of control, right? But we saw similar activity earlier with some of that trading. So it can happen. It can be a little bit of a risk appetite gauge. It's part of the reason that I'm watching it right now. You can form your own portfolio just with the stocks. And if you look at that right now, and I think I'm up to date. I got to review it to make sure I have all the names in here. But if you look at the current setup for the stocks, it just now, even after those recent gains, it's just now starting to move higher. What does that communicate? Well, there's potentially a lot of upside room there. If it can move above neutral, you can see where it was back in June before everything started to move lower. So a little bit of a risk management gauge. It outperformed the broad market by 10% in a 1 week time frame. And I see a little bit of a battle brewing here. One between a risk management appetite and the fact that Tim already mentioned this. We're above the red line. And I circled it in the image today in the note. You look at the times where it's been above the red line here on a year-to-date basis. Every single time the market slowed down. And over the course of the last 6.5 years, when you are above the red line, we tend to be about 9 days on average above the red line, market returns of about 55 basis points. So the market doesn't just collapse in general terms. We've had a couple of outliers. But the market doesn't tend to collapse, but also, as Tim pointed out so well, these types of gains tend to slow down for a period. So I'll combine then two thoughts as we look ahead, and Tim can join in if he has any other thoughts. We're at a natural point now at the red line, moving above the red line, where market gains tend to slow. But in the background, at the same time, we have a potential risk management gauge that is going crazy. There's the SOX, and outperformance versus the S&P 500. So which way do we go? Don't know right now. But I'm watching the semis here over the next couple of days to see if they continue to catch a bid. Even today, they're doing pretty well. They're up over 1% today with the broad market lower. Do we see a continuation of that? Don't know, but that's certainly something that I'm watching, and it's a little bit of a battle line right now to me between the broad market hitting 6 and the semis catching fire, and we'll see which way that goes.
Yeah, the only comment and we're at the end of our time, that I would add, I was just reading what you were saying there, Brad, is this. I'm just going to share my screen really, really quickly here. You can look at like SanDisk, Western Digital, which reported Datadog, which was a daily trading idea stock, but you always got to watch when earnings are reported. Why would it drop 20%? Well, technically, it's because 20% of its market cap comes from derivatives. And if those get marked to zero, there goes 20% of market cap. But in the data, how would you know? We can have a quick look at this. This is NVIDIA. So, if you could pick a chip stock, there are exceptions to it because you can go look at them. It's not awesome. It's bottoming, and you can go back and look at what has generally happened when it's bottomed before getting to 1. But really, demand has not been good in NVIDIA since April. This is not awesome. It rises because supply declines. That's what's driven the price up, and you can see that. So is that sustainable? Generally not. Doesn't mean it won't be. Then, looking at Datadog just really quickly here, how would one know? And you wouldn't. I mean, I can't tell you that looking at that, would I say, well, that stock's going to get clocked? No, the demand side looks good, and demand trumps supply as a general rule. But when they move the same direction, that is not nearly so good as when they move opposite each other. There's no question that strong demand with declining supply is superior and produces returns until demand diminishes. It's not a perfect read, but certainly you want to be very careful around earnings because you just don't know. To me, this is here's a classic example of great demand supply balance. It's a very small company. I've got the head of IR from this company on a panel next week at an event in Dallas. And I mean, 10 and declining. So the supply is way too high. It's about 82% short. They could use their equity as currency and expand the supply and reduce that. But this demand supply divergence tends to produce reliable gains. Not perfectly, but those are the things that you can generally look at. Looking ahead, my concern, I said on Monday with Dennis and Joel, on pre-market prep that it's the end of the beginning, purely by looking at all the chips. As Brian said, it's turning the right direction, but my concern is that this is a very long time to have weak demand, and the supply line is not awesome. And so I would need a lot more data before I would say we're off to the races again on the AI trade. I think it's the end of the beginning. Doesn't mean we won't have periods of epic returns, but I think that trade is over, at least for now. Who knows, right? I just know that is not the condition that has produced the booming returns that we have seen in the AI trade. Then I think, Brad, your question was about the market goes as big tech goes, and big tech has done well. So yeah, I certainly think that way. Big tech is back over 5. But supply is rising too. And when supply and demand move the same direction generally, in a momentum condition, it's different. Generally, that slows demand down. It's like a headwind. And so to me, this could be very close depending on the rate of change. I mean, do we top next week in the group? Maybe. So that's fine. And so if the market goes as big tech goes, the market is fine, but that's how I would conclude. Anything to add, Brian? Took you 5 minutes over.
I was muted, but no. Do you have any thoughts on? Joe had one last question about Bitcoin, recent trading there versus a choppy, volatile stock market. Do you see any correlation between the two?
Okay, and Brad, I'll answer part 2, and then we'll let you guys go. Joe, I don't know enough. It's not my area of expertise to know if there's a correlation to it. So I don't know is my answer. It's not how I think about it, but I'm an equity market structure guy. That's the stuff I know. And so to me, what changed in June is that money stopped. I'll go back to SPY. It's the first dip below 5 since April of 2025. It told me that the rate of flows to the market slowed. So even with these arbitrage swings creating big moves in the market, I do not see that condition has changed. Brad, to broadening out, I say the market cannot broaden out. I know everybody talks about it. 90% of assets in ETFs are in large caps. 140 stocks are, give or take, 75% of the market. I can correlate mega caps. I could correlate 4 mega caps to SPY to a 90% correlation. So the market cannot broaden out because all the instruments are reliant on large liquid securities by structure. It's not a choice. ETFs can't just look around and go, oh, I'll take a basket of small caps instead of a basket of large caps. It's like pouring water from a 5-gallon bucket into a thimble. It's why the RUT jumps periodically. It's a tiny little bit can change the outcome, but the market is not possible in a market dominated by ETFs for a broadening out to support the market. It is dependent on large caps. All you have to really do, to me, and I want to let you go here, is I'll just remind you to create a mega caps portfolio. And that is how the market goes. This is the best indicator of the market, and it's got solid demand, but supply is rising. I don't know what's going to happen there. The trend line is not great on the supply side for mega caps, which have vastly lower short volume than the general market. The general market's over 50%. They average 40 to 45%. Call it 45%. There's far more real money in mega caps than all the rest of the market. And so that's how the market goes. And to me, it's not great. This was a good, solid period, and it's approaching that again. I'm watching that. And if that deteriorates, if that were to drop below 5, then I think the market could tip over, right? But there are all other things that can cause the market to tip over. I'm not, it's not the only indicator. Okay, we went long. Apologies. We will see. I will be traveling next week, which means Brian will be flying solo. So that's one you don't want to miss, because that's where you get the good stuff. So thanks, and good to see everybody. Have a good weekend.
Thanks. Take care, everybody.